Hello, everyone, and thank you for joining us again for another Mogul June real estate webinar. And with me is, I'll start off with that. My name is Alex Blackwood, CEO and co-founder of Mogul, and with me is
Joey Gumatau, COO, co-founder as well.
President, et cetera, et cetera.
Lawyer, accountant,
Best
Alex
man
is as
at my
well.
wedding. Yeah, just things of that nature. But appreciate you all for joining us. Obviously, June was a pretty crazy month, and not just within the real estate landscape, but even outside of it. And we announced May dividends last week, and so that's going to be a pretty good good focus of today's webinar. But of course, we'll give it should we give it like a second or so more before we dive fully into it? I think.
Yeah,
So, right,
sounds
yeah.
good.
But appreciate everyone for signing up and checking out. Oh, and we're climbing. All right. I mean, honestly, let's just dive into it. Why not? All right, Joe, do you want to take it away and it was obviously one of the strongest months of dividends that we paid out just consistently. I think it was 7 of 13 properties were above 11%. And then,
Right.
or it was like 10 of 13 was above 10%. And then 13 of 13 were above 9%. So obviously a phenomenal yield in May. Do you want to just take us through what happened, the performance, anything?
Yeah, I'm waiting for the drum roll.
I drum roll. I got no way to drum roll here.
Boom, there it is. All right. Let me know when you guys can see this.
Yep, we can see it.
Perfect. Yeah, so this is a recap of our May performance paid out in June, right? So we pay out a month in arrears. Again, we pay out our dividends third Thursday of every month. You will see the dividends appear in your account with a notification as well as an email go out for the previous month of full performance. So we paid out these May dividends this month, and just what a solid month it is. Obviously, getting into the warmer months, you'll see a lot more occupancy activity across all the Airbnbs. Incredible highlight for the Johnson there, right? Surpassing 1% even with debt service. Just an all-out great month. And then you'll see a lot of the pad splits continuing to perform really, really strong. The Rhodes is the pad split that we launched in Arizona as a reminder. Very, very consistent, strong performance. We will have additional pad splits coming out in Arizona soon, so stay tuned for that. You remember the Andres, the Mafi, the Prince. These are all Atlanta pad splits. We're continuing to expand in Atlanta. We love the Atlanta market when it comes to the viability of pad split operations, the friendliness with zoning considerations and permitting, the financing capabilities. It's just incredible. The Celeste, as a reminder, is an awesome Airbnb in Houston. And then you guys know the Shiv, the Axelrod, the Krakow, the Logan. These are all OGs on the platform. The Kendall, the Victor, also a pad split as well. In that one's also in Atlanta, and then the Roman is the Houston Airbnb that has been performing really, really consistently for the past almost 2 years now. So yeah, great, really, really great month overall. I think definitely indicative of kind of what performance is going to be like through kind of the higher activity vacation months, the higher activity kind of transient occupancy months when it comes to your midterm rentals. And so, definitely excited to see how the performance carries through the summer and fall. Really, really excited about it.
Yeah, I mean, I'd love to highlight, obviously, across the top row, we have 4 pad splits, and then the second row is, I mean, that's also 3 Airbnbs. I'd love it if you could talk through, I guess, why is there such seasonality in the 2 different offerings? I know, obviously, a lot of the investors that come to our platform, they're looking at a mix of the yield versus appreciation, and so this is just a highlight of the differentiating factors between pad split and Airbnb. And if you could just highlight real quick before we dive into it.
Yeah, 100%. So yeah, as Alex mentioned, the Rhodes, Andres, Mafi, Prince, these are all pad splits across various markets. Consistent performance in and around kind of the typically 80 bips to 1% range per month, annualized to 10 to 12% plus, which is really, really great. Those properties business plans, as a reminder, are really, really focused on cash flow, right? So we're not forecasting 4%, 4.5% appreciation in a kind of high growth, secondary market scenario like we are with a lot of the Airbnbs. Atlanta is definitely a growing market. It's definitely the employment fundamentals, the population growth fundamentals are definitely really, really strong. But when it comes to the pad split fundamentals and kind of the business plan, you're really looking at more of a high yield kind of fixed, what I like to think of as almost like a fixed income approach, right? Where it's like you buy an asset kind of at par, at value. It's going to appraise right at around where you're purchasing it, if not slightly higher, but nothing crazy like we've seen on some of our Airbnbs that have, 7-10% appreciation on purchase price day one with appraisal value. And so these are, these are month to month rentals, 31-day plus, where again, all the tenants are renting each bedroom, but they have common area access rights. And so it creates a revenue opportunity as a multiple on what you would see in renting out a whole house, like on an Airbnb sometimes, right? Like a typically 2 to 2.5x actually in revenue multiples for the same square footage. Now, again, the trade-off is that you're not experiencing that appreciation. So kind of carrying that over to what we're seeing at like the Johnson, the Celeste, the Shiv. These are 3 incredible Airbnbs, right? The Johnson in Austin, the Celeste in Houston, the Shiv in Houston as well. Very, very high performing. These are a little bit more cyclical to seasonality. So in, the summer months, the early fall, the kind of mid to late spring, you're going to see really high spikes in occupancy. And when I say high spikes, I mean like you're going from 45 to 50% to like 65 to 70%, which is significant. And so, you're seeing dividends that are cash on cash, at or above 1%. Whereas maybe in the down months, you're seeing stuff closer to the 60 to 70 bips, which are all still tremendous dividends, mind you, right? These are all 7 to 12% annualized dividends. And that's really nothing that you ever see in real estate. The trade-off there is that you do have appreciation baked in, right? We're creating operating businesses when it comes to, working with these Airbnbs. The financing markets are a lot further along. The buyer understandings on the investor side are a lot further along, and what kind of liquidity you can experience on the back end. And so you're going to be able to sell these Airbnbs for a higher premium than you would say the pad splits, where it's a little bit more of a nascent market. People are still figuring out those value propositions. But nevertheless, incredible yields across the board.
Yeah, and I mean, it speaks volumes, obviously, that there's such a strong performance across all assets within the portfolio. And not to mention too, I mean, you hit it right on the head, right? It's if you're looking at yields and you're looking at something that'll yield, and that's part of your consideration when investing, it's either this or like obviously interest-bearing savings accounts, which will be around 4% maybe on the high end. And so it's either this at the 10 to 12% with tax protection against it, or a 4% that's going to be 2 to 3% post taxes. And if you're just joining us, thank you so much again for checking us out. I would say write any and all questions that you might have in either the questions or in the chat. The chat, everyone can see the question. The question section, only we can see the section. So if you want to be a little bit more anonymous, I got some feedback on the Mogul clubs, and we iterated on there. So now it's only first name there because people definitely wanted and valued their anonymity, especially in the posting settings. So by all means, feel free to shoot those over in the questions and the polls. I mean, Joey, with that overview of the May dividends, is there anything else you want to highlight before we dive into? I know we've been talking a lot about how the Johnson has been absolutely crushing its first 2 months, the first month actually being a stub month and performing at an 81 bip cash on cash yield. And then this second month above a 1%. And we're heading into even stronger months for the yield. I mean, if you wanted to touch on, I know we were talking about the Johnson too a little bit, especially as we're entering these prime months for it.
Yeah, 100%. And let me actually go ahead and share the Johnson 2, just as a reminder for everyone on kind of what that property is, what the value proposition is, how the Johnson 1's performance is going to translate into that as well. So as a reminder, let me know when you guys can see my screen.
Yep.
Perfect. So here we go on the property page, the Johnson 2. This is one of the active properties now. It's the Johnson 1's big brother, effectively. It's right across the water in Austin, just as a reminder. Five-star Airbnb performance, right? I mean, across the board, the reviews on the listing are tremendous. So, we've maintained the existing management in place, which is great because all the reservations that were booked throughout the year transferred with it. And so, thinking through, again, just translating the Johnson 1 performance to the Johnson 2, one of the things I like to highlight is one, the Johnson 2 is closing here, early to mid July, right? We effectively, when we close a deal, and we've been transparent about this in the past, just so everyone knows, when we close a deal, we actually don't pay debt service on the loan until the month after the following month. So if that makes sense. So if we close anytime after July 3rd, really, we won't actually be paying our first debt service payment until September 1st. So the month of July performance, the month of August performance, that will all include cash on cash yield that is exclusive of any debt service payments, right? So we've seen dividends in the past upwards of 1.4%, 1.5%. That's what we're effectively going to see here, especially going into the warmer months, that aside. But when we close on a property like the Johnson 2, which is closing imminently, again, first 2 months essentially are no debt service payments, depending on the timing of the closing, which is tremendously valuable for those early investors. Now, thinking through, again, just getting into the warmer months, right? This is just a prime location in Austin. Alex was actually out there very recently. He can probably speak to it. But thinking about kind of where this is located and what the business plan looks like, again, this is the largest deal that we've done to date. It is a over 2,400 square foot, 5-bed, 3-bath, all beds with private bathroom access, $2.2 million property that we purchased at 70% LTV. Year one rents are really, really strong at around $300,000. And we're looking at, year one performance that's actually on par, very slightly under where the previous T12 and T24 performance have been on the past 12 to 24 months. You look at some of the comps in the area on Airbnb and AirDNA, and you see a lot of properties that are even smaller and, located in very, very similar areas performing even better. So very, very, very good kind of balance of fundamentals when you're looking at justifying your assumptions here. As a reminder, you can go in the analysis tool, which I'll jump into shortly, on a new property and underwrite all the assumptions yourself and kind of stress test what you want to look at in terms of your own assumptions, your own inputs, and then see how that translates into your annualized returns over 5, 7, 10-year hold, whatever you want. So yeah, just to highlight, really, again, highlighting the Johnson 2, it's selling fast. I think we actually potentially just got some live investment I'm getting from Thomas.
Yep. Yeah. Thomas mentioned that we should refresh it. Is your internet still out?
Awesome.
Did it? No, wait, hold on. Refresh again real quick.
Boom. There it is. Yep.
Oh, there we go. All right. Yeah, I thought your internet was out. Well, that's good. So yeah, I mean, just to echo Joey, I mean, that's a crazy thought. The fact that this is going to have no interest payments for the 2 prime months of the summer, not to mention too. I mean, we're going as a corporate retreat out here in just a little bit. We'll be out there in early July. So to the extent that you all are around, let us know, and we can maybe host you over at the Johnson 2. We might have a cocktail hour there or something for investors in the area. So definitely reach out if that's of interest. Also, if you are looking to book Airbnbs in these areas, we've been asked a lot for the booking links for them. And so if you're an investor, we'll even potentially do a discounted Airbnb stay without the fees as you go direct to us. We had one question come in. I'm here in Dubai and I see thank you for joining us from Dubai. See the real estate market is hot here. Are there any plans to go into international markets? Currently, we are focused entirely on the US markets. I mean, I completely agree that the Dubai markets may be attractive, but really the US market has shown resilience through any sort of fundamental shift, especially in the macro economy. And so if we're thinking about it, we're going to focus entirely on US for now. That's not to say in the future, when we get more property specialists in Dubai, that we might not go into there as well. And so, Joey, I think we also got another 10K investment into the Johnson 2.
Sweet. Yep, there it is. Yep. Awesome.
There we go.
And yeah, adding on to that too, I think macro fundamentals aside, like we operate with a tremendous competitive edge in the US right now. So again, we always go through basis, business plan, exit, but when you're thinking about vertically integrated operators on the brokerage side and getting properties off market, 5 to 7% below asking price, you're thinking about property managers who are aware of court cases in municipalities of permitting issues on the Pathwood side or Airbnb side that you want to avoid. and getting their opinions on properties before we even go under contract. When you're thinking about lenders having capabilities of operating at the rate floor and targeting specific markets with us, these are all things that we built around the infrastructure within the U.S. real estate market. And so that's also a huge reason why we focus on that for now.
Perfect. Yeah, and then we do have a few quick questions right off the bat. Is from Joe C. Cacciapaglia. Thank you for joining us again, Joe. Appreciate you joining. Is there a reason the sales comps chosen for this property are much larger square footage than the subject? Is the square footage on this property listing accurate? It looks like the Johnson 2 is 2.4 square foot, 2.4K square foot, where the two comps are 3.3K square foot.
Yeah, I mean, so really it just comes down to the appraisal, right? And going through kind of what properties were chosen to appraise the property at value. And so this property appraised exactly at value at 2.2 million. And so we just used the exact same comps that the appraiser used for that formal opinion of value to justify our basis as well.
Great. And then Brad reached out with, what is the time frame for accepting USDC for funding? We actually had a call about that last week. So we currently do accept USDT, and we're in the process of implementing USDC. I think you can expect that probably by end of week, if I had to guess on there. So thank you for reaching out about that, Brad. And Thomas, if you want to make a note of that, I know you're on as well, just so that I can be reminded of that. We also got a private one. How long have you had a partnership with the Pad Split team? What is their incentive to sell some properties to Mogul versus continue to operate for them for their operations? I can let you touch on the operations, and I can touch on this Pad Split, but we've been working with the Pad Split team for quite some time now. We were actually just at dinner with them last week even, and so we're pretty close-knit over there. I was at a launch event that they had over in Boston where we could sell Pad Splits in real time to an audience, which was great. And so the Pad Split team has been a great partnership. We're continuing to grow alongside them and with them. And so, Joey, if you want to touch on what is their incentive to sell some properties to Mogul versus to continue to operate them for their own operations?
Yeah, so it's a good question. Like Pad Split's business model effectively is a platform, so they don't actually like own the properties and operate themselves. They did go through a property management arm that they were building, but I think have since kind of put to the side in terms of priority. But effectively, like the Pad Split platform is like Airbnb, but for midterm rentals, right? And so the incentive for us to be able to work together is that we're bringing awareness to Pad Split investment, right? Pad Split's still super, super nascent. It's not at all popular like Airbnb is. I would say it's probably at a place where Airbnb was like 5 to 7 years ago. And it's just starting to hit its stride in terms of, again, financing capabilities, investor appetite, inventory across the US. And so their incentive is obviously to grow with us. And just we're, given we have such a big footprint, both in our portfolio internally, but also just expanding our reach across all of the target markets. They've definitely taken notice, and we've actually been introduced to them through several different channels. And it's to the point where we've definitely started to make waves with some of the off-market opportunities that we're putting in bids on, where word will somehow get out and it'll come back and I'll hear about it through another channel. And it's really, really cool. But yeah, they're incentivized to grow just like we are. And, we love the Pad Split product. Again, it's as close to real estate fixed income as you can get. Just from a risk profile perspective, from a yield perspective, really, really strong stuff. And so, we'll continue to expand that product on our portfolio as we grow.
Yeah, I mean, their vetting process is absolutely extraordinary when it comes to the tenant. It's unlike any others that I've seen out there. It's definitely more strict than any of the platforms that we've looked at in the past, whether it be even short-term or mid-term rental or rent by room. And so it gives us greater confidence in the broader team. They haven't cut any corners. They've actually gone completely in the opposite direction and really are fighting for this type of operational model in every jurisdiction that they enter. And so obviously we're going to continue working alongside them. And so there was one more question that was asked. If I'd like to create thank you, Brad, for reaching out with this question again. I'd like to create sub portfolios of my properties. For example, I'd like to group my STRs together and my Pad Splits together. But more importantly, what I'd like to do is create a couple subcategories under my account, one for each of my small children, to let them pick out a property or two each and have them start to learn and watch their property under my account. Thank you for that suggestion. Can this look to be added from Brad? I do think it can look to be added, and actually, something that we're going to tease later on is we have a much more automated flow with 401k and self-directed IRA investing that we're going to be rolling out later this week. And so that might go hand in hand, exactly what you're looking at. And it'll also go hand in hand with entity level investing. So using an entity to invest in properties. But Brad, Thomas, could you reach out to Brad and just let him know how we can set this up right now before we have it in a more automated fashion? But really appreciate that feedback, Brad. As you can tell, we take the feedback very seriously here, and I'll walk through some of that later on. And then one other one, Carlos Alonso. In learning your business model, I understand once a property is acquired, Mogul creates an LLC that owns the property, and the investors are listed as part owners of the LLC. Is this right? And is that how personal risk addressed? Correct, Carlos. So people become owners within a PropCo LLC that is purchasing an asset. And so the PropCo LLC, obviously, it's a limited liability company. And so you have limited liability when you invest in that property. And so you have limited liability when it comes to tenant and the occupancy of the asset itself. But on top of that, you have limited liability as it relates to the leverage that's taken out to purchase a property. Again, those don't come with any of the personal guarantees traditional with investing. We actually put out a leverage piece today on exactly how that works, but it's limited liability. And so Thomas is reaching out to Brad. And will there be a time we can purchase more than one property in one transaction, add to cart type functionality? Thank you for that, Angel, or Angel. To be honest, I don't. Anyway, I think we can add that in the future. We've been playing around with some pretty cool functions here. Now, as we're getting more and more properties online and trying to add more and more supply online, we're going to be coming up with newer and better features for purchasing properties. So I think I have exactly what you're looking for in mind. And Joseph, we can go over that in just a second when we go through the Hugo. I think he has a question about the Hugo, but Joey, did you want to take us back through some of the stuff on the Johnson 2? Anything left here?
Yeah, no, I mean, just really wrapping up. Again, you can go into the analysis tool if you really want to deep dive into what the value proposition is of the Johnson 2. And I know we're going to go through a property here shortly, but again, here's the analysis tool. Normally you can go in, type in any address that you want across the US and underwrite a property accordingly. And then, once you go through and create a property, the property page will come up. You can go through, switch between the toggles in terms of like your case scenarios and then also your business plan. And then you can actually go through and start toggling all of your inputs. And then, in real time, you'll dynamically see your returns change at the top as you put in those new inputs. And so, I would highly encourage you to go and look at the Johnson 2's analysis tool, play around with some of the assumptions, look at the comps to make sure all of your assumptions are justified, and then see how that translates into value. And again, this one's closing relatively soon, and there will be 2 months of no debt service cash payout. So definitely beneficial from a timing perspective.
Perfect. Well, and this is one last question about portfolio analysis that Chris threw out in the chat. Do you have a particular target for Airbnb versus pad split? Joe, you want to walk through that?
So I guess in terms of splitting the portfolio, it's, typically 1-for-1. Honestly, we've been doing like, about 50-50, about 60-40 sometimes, Airbnb to pad split. Pad split's definitely been taking up more of the portfolio as we grow, mainly because of where the capital markets are right now, right? Just like tracking rates, making sure that these yields can beat the APRs that lenders are giving us. Pad splits, it's basically a given any time with at least good quality that we're getting through our pipeline. But with Airbnbs, it's a lot harder to find in that buy box. They exist. We have a lot of them, which is great. And then in terms of what we target for the buy box, that really just depends on the market, right? Again, when it comes to basis, we're going to want to make sure it's kind of purchase price in the 400 to, $1.5 million range. On the Airbnb side, it's a lot more variable. And the fundamentals just have to make sense from a basis, business plan, and capitalization perspective. We'll take out the quotes from our lenders, make sure that the APRs are there, make sure that the yields qualify at least 1.3, 1.4x on those APRs. And then we will push it through our diligence process, and then eventually launch it on the platform. Pad Split's very similar. We run pretty much off-market processes for all of them. When you're thinking about like Atlanta, Phoenix, Houston. And so we maintain that pipeline and can kind of hand pick and choose from properties that are all really yielding over 9 to 10% NOIs on historical 12 months, which is great. So we've had the opportunity to kind of have the pick of the litter for now, and we'll continue to maintain that quality as we grow.
Wait, what was your ABC trick again? Like basis, business plan, exit. Like what was it again?
Always be closing. No, basis, business plan, exit. Yeah, exactly. So basis is justifying your purchase price, right? Like using comps to make sure that your purchase price is justified. So that way, you have your 3 contingencies, and that'll cover your purchase price and all of your terms. Business plan is everything associated with obtaining that yield, right? So making sure your leverage is in place, that APR is in place, and that NOI is in place and justified to beat those yields. So that involves comps to justify revenue and rents, expense analyses to see, where taxes are, where insurance is, and then eventually capitalization, right? So exit to, which is, cap rate expansion, cap rate, the opposite of expansion, inward. And then making sure that obviously property values are continuing to grow and trend in a positive direction, typically 2 to 4%, depending on the market. Basis, business plan, exit.
Was the opposite of expansion contraction?
There it is. There it is.
And I'm the one with the concussion. Okay. All right, sweet. Should we jump into the Hugo?
Let's do it.
Great. So we do have questions associated with it. And then also real quick, as he's pulling up the Hugo and going through that, Carlos, pad split equals rent by room. Yep. So it's renting in each individual room, which is more affordable on the room by room basis for the individual renting it. And then you have typically like an 8-bed, 3-bath, 8-bed, 4-bath that basically is split up so that individuals will rent that individual room typically on a kind of 12-week plus leasing. And so that's exactly right. It's more affordable on the individual room by room basis, but on the aggregate, on the whole, it presents that multiple, the premium associated with it of a 2 to 2.5 times, even sometimes short-term rental income, depending on the market. All right, let's dive into the Hugo.
Sweet. So yeah, normally when I go in here, right, I'll just type in the address of the property. So if you just type in like 1725 Shaw Street, you'll come up with the property in Dallas, right? There are kind of placeholder assumptions that are in there, but then you go through and you actually do the underwriting step by step, right? So let me just walk you through kind of how I look at underwriting these assets. And again, shout out to Alex and Eitan for putting this calculator together. It's actually pretty much all I use now, outside of some Excel analyses, instead of just using your typical old Excel model. So this is really, really great. I highly urge all of you to go check it out for sure. But yeah, so, just go through again, you'll see the comps here at the top, and then those will help you justify your assumptions, right? So really you have your sales comps to help justify your basis and exit, and then your rent comps to help justify your business plan and operations. So, you go through, typically you want to go through and underwrite a monthly rent in line or below where your previous like T3 to T6 monthly rents have been. The reason I don't say T12 is because T12 performance is what we like to look at from an NOI perspective. That's really seeing a full year of post-expense, post-revenue collection assumptions, because there's seasonality associated with revenue. There's seasonality associated with expenses. You're going to make sure that you have a full picture of that. So I typically like to look at the T3, T6 for rents, mainly also because there is sometimes noise. And when I say noise, I refer to things that are like affecting your analysis kind of in a way that's going to create variability that you don't need to take into account. So when it comes to like noise on like a down month or 2 down months in rents, like you're going to want to isolate those, figure out what went wrong, see how we can mitigate against those, but then underwrite what those rents would truly be in a go forward business plan based off of what our property managers are saying, based off of what we think is reasonable, based off of our portfolio and what we see in across the portfolio. So, you go through, you justify on your base kind of what monthly rent is going to be. The calculator will automatically spit out the annual rent. Growth rates are typically, in the 3 to 5% range, right? In terms of top line income growth. So this isn't necessarily, NOI growth, right? This is just assuming slightly above inflationary growth on rents. With bull and bear case, I typically like to be conservative. Some people will underwrite 20% variances, 30% variances in bull and bear. I like to pull in the bull a little bit and then really hit the bear case, sandbag it, as we used to say at GS. Just really hit it hard to see like what truly like a bad case scenario looks like in your underwriting. And then you go through, so that's your revenue, right, on the tool. And then you go through and you can go through your OpEx, all your operating assumptions. Property taxes, right now, I've actually gotten in the habit of underwriting every single asset, assuming it's fully assessed at value, right? So, for example, states like California and Texas are very transparent with their assessment of properties, especially after a closing. And so you're going to see that assessed pretty much at full value, if not slightly less. You can appeal values, which a lot of people are really into these days, and we've done in the past. But ultimately, you're just want to underwrite conservatively what those property taxes could be on an annual basis. You have your dollars per year, right, in terms of what your taxes are going to look like. There's no HOA at this property, but if there was, you would be able to put in your HOA assumptions on a monthly basis. Homeowners insurance, we've been seeing premiums typically in like the $300 to $400 range, sometimes upwards of $400, depending on the size of the property, right? So it'll depend. The two things that move the needle the most are really your dwelling coverage, like on the value of the property, and then your loss of use, your loss of rent coverage, and that will swing according to how much rent you're losing, right? So if you're getting covered for 100K of rent versus 30K of rent, obviously that premium is going to look much different. So this is a pretty medium-sized property in our portfolio, and typically we've seen premiums in and around $300 to $350 range for this size. Miscellaneous costs will really account for any maintenance costs when you're thinking about landscaping, which is typically 150, $200 a month. When you're thinking about restocking fees, which could be anywhere from $50 a week to $70 a week, typically, just to restock some of the supplies in the house. Property management, percentage of rent, right? This is typically going to be 12%. And then, we have our 2.5% Mogul fee on top of that. So I just round that up to 15. Again, being conservative, right? It's always good to be conservative. If you're ever justifying going down in an expense assumption or up in a revenue assumption, you want to be able to justify it. If you're going to just add in a little bit of buffer just to make it a little worse, that's fine. I recommend it. I do it all the time.
Yeah, having fun with it. Wait, also, Joey, on that, you touched on homeowners insurance, and this question from Joe C is about insurance in particular. If we want to just quickly rip through that as we're thinking through that. But also, Marshall gave a good shout out to Joe. Thank you for all your formative YouTube videos, new here, and I really appreciate your perspective. Yep, I agree, Josie. Great YouTube videos there. Thank you again for the continued support. And then so Joe C, and this is Joe Cacciapaglia, by the way. He has a great YouTube channel there. But for the Hugo, is there any real impact of being in an X shaded zone as opposed to a regular X zone? Is flood insurance required and or advised in an X shaded zone? This was a new one for me.
So we do take out supplemental flood insurance regardless of the flood zone, just because that's part of our umbrella coverage. And so just as a reminder, again, we do have two forms of insurance: landlord and dwelling. Dwelling covering all force majeure acts of God, and then liability and landlord insurance covering loss of use and liability on renting to tenants, right? And the potential liability when it comes to getting sued, whatever it is. It's just we get typically covered up to $500,000 to $1 million per incident of coverage on the liability side, and so that's additional landlord coverage that we take out. But yeah, to answer Joe's question more pinpoint, we take out supplemental flood insurance. Haven't had to use it, knock on wood, but it's there.
And also a reminder, definitely leave any questions and comments in the chat or in the questions, because we are more than happy to jump into them throughout the segment, and it definitely helps. I like to kind of see if I can quote unquote catch Joey here and throw something that he hasn't been caught yet. I'll give him that. He hasn't been tripped up by a question, which is pretty impressive. Pretty impressive this late at night. I mean, it's not even that late, but anyway, go for it, Joe.
Awesome. So yeah, just to kind of go through the rest of the assumptions here. Typically on OpEx, you're going to want to see OpEx that's in line, each year. If it's increasing by more than 2 or 3%, something's going on in terms of like, if it's, you have to pinpoint again, is it property taxes? What can we do to mitigate? Is it HOA dues went up? What can we do to mitigate or offset with rent? Maybe pass along some of those costs to the business plan and the tenants. Is it homeowners insurance? Whatever it is, you're only going to want to see like a very, very low inflationary growth in your expense assumptions. So really with the base and bull, I typically include, 1-2% max of inflationary growth. And in bear, it's typically 2, maybe 3% max. Capitalization, this is where we account for how we're capitalizing the property, right? So we have the purchase price here. And then on top of that, or I guess in between that, you're going to have your leverage, which is the mortgage that we take out in the name of the LLC. So this one, you can play around with what the LTV is in terms of like what loan proceeds you would like to see. And then that translates into an equity investment at the closing table, right? Pre-closing costs. So that's your equity day one, as we call it. And then you will see your closing costs, which account for any and all costs that need to be closed at the settlement table regarding lender, title, legal fees, all those quite literally hundreds of line items that you see on a settlement statement. And then your loan costs in addition to that, right? So these are buy down points. These are broker points. These are all things associated with closing a loan in today's environment and getting that rate floor that we operate at. That's, 6.5, 6 3/4 rate, which you really won't find for interest only loans outside of the Mogul platform, typically. And then you have your vacancy and maintenance reserves, typically 4 to 5%. We like to be conservative, 5% of the property. And then you have your Mogul fee, which we account for in miscellaneous costs down here. And so that's how you get to your total capitalized equity on your total investment size, right? So sources and uses table, right? Uses, you have kind of all the use of all your proceeds, the total capitalization. So like the property, all of the closing costs, all of that. And then your sources is going to be the debt and then the equity to cover the rest of the amount that you need to close. Financing assumptions, go down here. I highly urge you to play around with scenarios of what this could look like if, say, we started closing at 7%, right? See what that does to yields, say, which is great, very, very, very not dilutive, which is tremendous. And then, you can go through, play around, see what if rates get better and what if we start getting IO rates at 6%? What does that do to my return, right? Go up and you dynamically see, great, I just got a 50 bit bump on my yield and whatever it was, 60 bips, maybe almost half a point. Yeah, 60 bips on my IRR. So really, really great tool. Again, shout out to Alex and Eitan for developing this. You can play around with your fees, your percentage rate, interest only, right? You can see your amortization table here, which is a kind of a breakdown of all of your payments, amortizing versus interest only. Refi, it would be honestly unrealistic to not include a refinance in this environment right now, right? 5 years down the line, we're going to assume that as they always have in history, rates will eventually come down and settle probably closer to the, 3.5 to 4.5, maybe 5% range, right? And so obviously we've been at a peak in terms of where interest rates have been over the past, honestly, 3 years basically post COVID. Very, very interesting time, very weird time for rates and kind of the market in general. But the market always swings and it will eventually come down. So we do underwrite a refinance in 5 years out in the business plan. And then you can see your break-even analysis here and what that looks like. And then also your exit assumptions, right? So you have your DISPRO here. And again, the DISPRO is driven, by the appreciation here, right? So your appreciation rate is going to drive your DISPO value from that initial cost basis ultimately to that end value based off of the term of the total hold period, right? Which you can then change here. So you just rolling that all up, you can go down if you really, really want to get into it, you could see your actual cash flows line by line, year by year, go through, walk it down, revenue, expenses, unlevered cash flows, NOI, capitalization, get down to your debt, levered cash flows, and ultimately how that translates exactly dollar for dollar into your cash on cash yields, right? So really, really great tool. Highly recommend check it out.
Oh, how the turntables have turned.
Oh, how the turntables, as Michael would say.
What? Yeah. I remember when we were first building out this tool and you bet me that I couldn't build an entire Excel model in one single Google sheet. Oh, how the turn. No, I'm kidding. But
I'm paid to hype it up.
yeah. What?
I'm kidding. Said I'm paid to hype up the tool.
You're not paid shit to hype up this
I'll
tool.
take that $20 later. You can drop it off at my desk.
$20. My God. You sell yourself. You sell your stance on a tool for $20. Jesus, we offer a $50 referral bonus, Joey. Yeah. And if you refresh, I think we got another 5K in there, which is great. So thank you to those investing in real time. I mean, I know we're coming up on 20 minutes here, so I defer to you if you wanted to rip through one quick other property, if you want to highlight any other ones. It's a fantastic calculator. I don't think you're overhyping it. Thank you, Joseph. I do appreciate that. I know Joey gives me a ton of shit for the amount of time I spent noodling over Figma on this thing. So I do appreciate that. And then Marshall, can you say anything about Mogul's plan for scaling up while maintaining the focus on quality offerings? I.e., I'd love to see more properties to choose from, which I can see that Mogul is a presently lean org, and you must be dependent on attracting new investors, or is it a matter of identifying quality properties? So I can touch high level on that, and then Joe, if you want to touch on the expansion plans. But we are launching a new property per week at this current cadence, which obviously is definitely a higher cadence than we did in the past, and it's only getting faster and faster, which last quarter, I think we were launching a new asset per every 2 weeks. Now it's an asset per week. And next quarter, I do believe we're going to continue to up that cadence. And we haven't faltered in the quality of supply that we've listed out on platform. We've actually more than doubled assets on platform since even the beginning of this year, which is absolutely incredible. So outside of that too, how do we maintain that type of quality? We are actually hiring. So to the extent you are interested in becoming an investment analyst at the platform, we're doing some pretty cool, unique things behind the scenes. And so as it comes to finding and identifying quality properties, we have a fund model outside of this that's going to be investing and bringing more properties online. But outside of that too, Joe, if you want to touch on the actual supply side, but demand side, we've been ramping up like crazy. We've hit peak weeks over the past few weeks. And so, Joe, if you want to touch a little bit more on the supply side.
Yeah, so typically we like to have at least 5 or 6 active properties to choose from. Now, when it comes to the product itself, right? I mean, you have a decent. I mean, just at any point in time, you have a decent mix of, Dallas Airbnb, right? Atlanta pad split, Austin Airbnb, and we have an Arizona pad split coming online, and then another couple Airbnbs that we're looking at in the Seattle area, and then outside of that, some Colorado Airbnbs that are coming online here within the next quarter or two. Typically, when it comes to expansion and ramping up this quick and doing a property a week, it really comes to one, maintaining the workflows on closing and asset management, which luckily we have incredible teams, boots on the ground in all of our markets that we work with, property managers that are tremendous and tremendously valuable to how we operate the assets on the platform. And then two, on the actual property side, the product, it really comes down to supply pipelines, right? And we like to boast that we have a very, very strong infrastructure network on supply because we're getting all of our deals pretty much off market. They're all going through non-brokered processes. We're saving fees. We're cutting down on bases up front. And we're continuing to maintain, again, 8 to 10% plus NOI yields on previous performance, right? So regardless of what was going on over the past year, these properties are tried and true, 8 to 10% in NOI yield, which ultimately on, again, 6.5, 7% APR from the lender with 70 to 80% of the total capital or the purchase price covered, you're looking at, anywhere from 10 to 14% in terms of your year one annualized yields, cash on cash. And so, maintaining that supply pipeline is going to be really, really crucial. And that's luckily we're actually at a point right now where we're oversupplied, where we're saying no to a lot of really, really great assets, honestly, that are, even in that 7 to 9, 8 to 10% NOI yield range, 3 to 4% appreciation in the go forward business plan. We have a lot of supply to push out with, and I think it's only going to get better from here. It's only going to, even as we kind of, walk ourselves into bigger deals, right? You know, we just got into the $2 million range with the Johnson 2. We're going to start, we've looked at some multifamily product, you know, full transparency, that we're starting to consider. And so, yeah, it's really all about maintaining that quality, maintaining the fundamentals. And no matter what real estate we're looking at, every single asset, regardless of what it is, ultimately comes down to the same model, right? Exact same revenue, expense, capitalization assumptions, basis, business plan, exit that you can apply across every single real estate deal, and honestly any equity deal in the world. But yeah, that's how we maintain our kind of quality, is through fundamentals.
Yeah, number one on that too, Marshall, we are hiring. So to the extent you know anyone looking for that investment analyst role or even developer, head over to our LinkedIn and see we have some openings there. So continue to grow out the team, which is absolutely incredible. Silent growth, which is awesome. The second thing, obviously, definitely refer us over to some friends and help as we continue to grow out in a very sustainable manner. We're in the business of creating a long-lasting business, and so that's we've been pretty grassroots when it relates to our marketing efforts, and so definitely would appreciate any sort of referral out there. The Mogul Club's great avenue to refer out and get some extra bonus rewards there. And then outside of that too, Joey, did you just drop an Easter egg of a property later this week? Just anyway, yeah, I heard something about a Phoenix pad split, and I was like, oh damn, all right, we're trying to drop that. There are a bunch of
There might be, there might not be. You never know.
Yeah.
I'm
There
kidding.
might be an Alaska property. We don't know. Like
maybe someday. Maybe someday.
Yeah. Also, there are a bunch of Easter eggs on the platform, and no one has picked up on them yet. I think eventually they will, but I'll leave that to the super sleuth. But out of that, I'm not sure that this has been asked in the past or not, but would you ever bring on commercial properties? So not commercial in the like we would look into the residential market. Our mission and ethos is centered around the U.S. residential market and really offering out investment for that exact property and specific type. And I do think right off the bat, cycle agnostic, everyone needs a place to live. You can pass along a tremendous amount of tax benefits onto the end investor, as opposed to if we were going into stabilized assets and we're going to compete against the Goldmans and the Blackstones of the world in the industrial space. No industrial seller in an interview would take any sort of crowdfunded platform, I don't care how big you are, and actually look to sell to them, right? If Fundrise entered the space and tried to go into a seller interview, that's kind of why they're subpar, in our opinion, is because when they enter into the space and they're competing against a Goldman, they're going to get outbid, outgunned at every single way. But what the space that we play in the single family rental space, we are the big fish in the small pond. We can enact those cost efficiencies at scale across all the different properties. And so, yeah, I always love to show Fundrise's return page because they brag about a 4% annual return. And if we had done that during our time at Goldman, we would have been fired. And we probably would have started this a lot earlier. Anyway, so that's on that. If there are any other questions, definitely feel free to ask it in the chat and throw them in the questions box. Outside of that, Joe, should we just, I think we're going to go use the last little bit to walk through some of the feature updates and the portfolio page, if that works.
Yeah, let me pass it off to you.
How do we do this? How do we share this new thing? All right, so yeah, I think that's the page. All right, can you see my screen?
Yes, you can.
All right, so we've been getting a lot of questions about the portfolio page. Just wanted to talk us through high level exactly what it looks like and in terms of the actual portfolio analysis. So this is one of our investors' portfolio pages. And so if I'm scrolling down, obviously you have high level metrics here, but we really wanted to dive into, we were asked right off the bat for more detail about your investments, because obviously you are investing in a real asset. We want to be as transparent as possible, but we also want to give you that feeling of how is my asset generating the returns that I've had to date. And so we introduced this exact table, and each individual property has this individual table attributed to it. So I can go through a little bit more here. Carlos, let's talk. Anyway, yeah, if Thomas, you want to take down that email? Anyway, looking into the table itself, if you see here, we obviously have your gross rental income minus your OPEX, minus your property taxes gets you down to your NOI or net operating income. And then minus your debt service gets you to your levered cash flow. Again, levered cash flow is just to you as the end investor. It's to the entire property wide payout for that property. Now, your ownership, this is just calculated as the percentage of your rental income yield divided by the total levered cash flow payout. We just wanted to display this on the go forward because sometimes your ownership percentage might fluctuate, especially if the asset is continuing to sell out. Now, in the monthly yields, this is what we do, which is pretty interesting, which is obviously it's just your yield divided by your investment gives you that monthly yield. Now, in the event that for whatever reason you invest midway through a month, we do have an adjustment there. And so meaning if you invest midway through a month, obviously you only have the last 16 days in a 31-day period that can be calculated, right? So to offer out a stub month and you invest midway through a month, you've got to calculate that in somehow. And so with that, this setup is taking that into account as if it was a full monthly yield. So we approach the monthly yield much the same way that we would approach the yearly and annualized yield. And so that's kind of high level there. Obviously, if you do have questions, feel free to reach out. I'm happy to walk through it even more in depth. On the annual yield, what we do here is we factor in the amount that's been paid out in that property to date. We divide it by the amount that you've invested to date, and then we multiply it by the number of periods left remaining. So if in month one, the monthly yield, it's pretty simple. You take the monthly yield and multiply it by 12. But if it's month 3, you take the year-to-date yield, so January, February, March, and then you multiply that by 4. So if that makes sense, Joey, is that making sense to you?
I tuned out for 2 seconds, but yes.
You're tuning me out? Are you kidding me?
I'm not tuning you out. As you know, there's always 2 separate flows at minimum going on in my head. And I was also reading Sadip's awesome comment about merch. So I'm excited, okay?
Yeah. All right. So would love to buy some merch, t-shirts, caps, you have them. That way it's easier for me to get people asked about Mogul and potentially joining the platform using my referral. Completely agree with you. That's actually what we're working on right now. And Thomas has some mock-ups of some really cool merch. I won't ditto on the merch. Yeah, I completely agree with you here. We've got some pretty cool merch coming your way, which is I don't think we should like tease it out, right, Joey? I don't know. Should we ask about do people wear white t-shirts or black t-shirts more? Actually, this is a great forum to ask that. I don't know why we haven't. Well, is it a white t-shirt or black t-shirt? All right, that's number 1 on the black t-shirt. Black.
Whoa.
Okay, black. Oh my god,
Alex!
Oh my god, I did not.
Shot yourself in the foot, Alex.
That was so helpful because we were about to order a ton of white t-shirts. So thank you for that.
Black and white logo. Yeah.
Yeah.
Gray. I like gray too. I like Tiffany's. I like gray.
I like gray, but I'm a sweater. I sweat a lot, and so like gray it's pretty easy to see unless you're doing athletic gear. So thank you all because you disproved all of our internal chats about this. So that's actually phenomenal feedback. I do appreciate that one. I'm glad I asked, honestly. That would have gone. So Thomas,
that was a literally unanimous decision. I don't think I saw a single
black snapback if y'all have hats. So we do have a few hats that we're exploring. So I completely agree. We'll have some hats for you there. I think they're super sick. The hats there. All right. All right. Here's another question. If a shirt had "Invest Like a Mogul" on the front, and then on the back it said "Alongside," and then it had the Mogul logo, is that good with everyone? Joey, are you typing this in? Yeah, I know there are pictures of you with Flo in your days when you thought you were a lacrosse pro, but you couldn't pick up a lacrosse stick to save your life, and you turned to tennis. And yeah, anyway, you turned to tennis because you thought you had a freaking snap. Maybe too much copy to read on a t-shirt. Yeah, I agree. It's the idea being that it's super small in front, and it'll be now white text on black background. And it'll say invest like a mogul, dot, 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 super small, super, super small in the back. And then it says mogul across the back with just alongside directly on the right. So it's super simple, or we'll do the logo, which is keep it simple. But I do honestly, that feedback is phenomenal. So
Super helpful.
it's really good on the merch component. So I'm glad we're looking into it now. And it was exactly today that we were about to order. So great. Awesome. Well, do appreciate that feedback.
We should do a merch drop too for all of our participants, like next webinar, and bring everyone back, and everyone that's on can place an order, and we can get them out there.
I like it. I like it. Yeah. We'll probably have to have another a house broken into pieces fraction. I like that. That actually sounds pretty cool. Like, do you get that? Do you get that, Joey?
Like on the back of the shirt, it says a house broken into pieces, fractional.
Yeah,
Yes.
it is that is kind of cool. Honestly, if we want to use, I was going to go over in-depth mathematical equations over here, but if anyone has any other potential slogans that they would want to see on a T-shirt, by all means shoot them in, because I think maybe a free merch where you invest more than a certain amount on property. I agree with that. We're actually contemplating a few ideas there. What about a deal toy? Would you like a deal toy if you invested in a property? And deal toy, hold on, let me see if I can get my Silvergate deal toy over here. This is a little bit, the Silvergate, RIP, obviously. Real estate invest, it's a deal toy. So it's like, for instance, we offered out
A commemorative like
in
trophy.
Silvergate. Yeah. And it was like, basically at Goldman, you compete to see how obnoxious the deal toy would be for a desk. And now this is proudly stored on. All right, Joey. Dude, this is the first. All right, this thing fell out, but this is the first one with a Bitcoin in the base. This was the first Goldman
That's
deal
cool.
toy with a Bitcoin, and that's pretty sick. I was
That's
trying
cool.
to get a Dogecoin in there, but they wouldn't let me do it. Bitcoin was okay. A small plaque, some for wall can hang, not desk. Okay, yeah, that's good. That's good to know. I like that. Well, this is all phenomenal customer research. I mean, if anyone has any other thoughts or opinions or questions on any sort of merch, this is tremendously helpful because we're putting in some orders later tonight. The deal toy's broken, by the way. My deal toy so maybe it is worthless getting a deal toy. Anyway, of course, socks. That actually is kind of cool. Other than logo on the front of the hat, logo on the back of the snapback. Yeah, Joey's a snapback guy, so I know he's going to argue for that. That's actually any affiliate program other than referral bonus. Oh, yes. Geez, we completely skipped over. Anyway, annualized yield, you multiply by the number of periods left, and so that way it gets stabilized over time. But the affiliate program, if I jump to here, share this tab instead. So obviously we have the Mogul clubs, and so there's an affiliate program here. You invite friends, and by inviting friends, you get 2% back, or people get 2% back in the aggregate of the club. We actually have been, if you have any more merch suggestions after tonight, feel free to post in here. That would be actually very cool. So the 400 Club, just as a high level too, it was back in the day when JP Morgan and the Astors and all the exclusive socialites of New York would gather together. It would be called the 400, and so that's why we named it the 400. Is it's kind of like the moguls, but it's the anyway. That's also a small little Easter egg there. But club hat might be cool. Club 400, I like that. So you can invite friends here. We get a lot of our great suggestions. So Wasim, for instance, he posted this. I'd love to see a bit of a FOMO, like with a what's remaining. So we threw this up in a matter of a day. So if you have any other suggestions, we're typically, so for investment returns, you can see here too, we added this feature into the portfolio page so you can actually see when the next dividend payout would be for it. And so that's kind of high level on the clubs. Definitely a request to join if you haven't already. And then, yeah, honestly, that's all I got, Joey, unless you have anything else.
Yeah, no, I think we're at time here, unless there's any last remarks.
No, I'm getting texted by my fiance to stop screaming in the other room. And I'm gonna get destroyed by that. What? Oh, she heard that. All right. We have fun here. We have fun. All right. Well, thank you everyone for joining us. I don't know, Joey, if you have any parting remarks or witty sarcasm that you want.
No, appreciate you all. Come to the next webinar and we'll have some merch ready for you guys.
The only time a divided home is good. That's actually pretty good. I like that. We have like invest like a mogul.
That's witty. That's really witty.
What about where cash becomes capital? Does anyone like that? Or is that just me?
That's a cool one.
We trademarked that. So we actually can use that. Have your slice and eat it too. All right, that's good. Damn.
Wow, these are great.
Use the trademark.
Really great.
A house divided is good. I don't know. I like the ... The ellipses just gives it some mystery around it. All right. Well, thank you so much.
We're out of time. Yeah. Thank you everyone so much.
Really appreciate your time. And yeah, I mean, maybe we'll do a merch drop on the next version of this webinar. Thank you so much. Spread the word. Thank you, Joey, for joining.
Yeah. Thank you, everyone.